What if you could withdraw money from your retirement account completely tax-free? No IRS surprises, no penalties, and no headache. That's the promise of the Roth IRA, but only if you follow a few key rules. In today's episode, we're going to walk through the 5 steps to make sure your Roth IRA distributions stay 100% tax-free and help you avoid the mistakes that cost retirees thousands every year.
Hey, we're back on the Retirement Elevated podcast. I'm Walter Storholt alongside Scott Dugan, of course, founder of Elevated Retirement Group. And great episode today, Scott, because who doesn't like tax-free? That sounds pretty good to me.
It is people are really attracted to it. And the reason we're talking about this today, there just seems to be a lot of confusion on how you can make sure that these distributions are going to be 100% tax-free. So we're going to go through the 5 steps to make sure you do everything right and don't get any nasty surprises from the IRS.
Yeah, it's a great point. And you're absolutely right, because there's all these different rules for all the different accounts that we have. And then you have to keep straight the rule of what happens on the front end when you put money in, as well as what happens when you pull money out. And so I know that can get very confusing for folks. So I know the first thing on your list, step 1 to figure this all out, is to follow the ordering rules. What do you mean by that?
So we need to remember that the IRS treats all of your Roth IRAs as one combined account.
Okay.
And this is called the Aggregation Rule.
Well, that's interesting. Okay. Yeah. I bet
so
most people don't know that.
No, because we hear we need to keep all these separated out and do this and that. But really, they look at it as one large pot.
Okay.
Now, when you take money out, oh, yes, absolutely.
Okay.
But when you take money out, it comes out in a specific order. And there's 3 orders they go into. So number 1, contributions first. So what you put in there is always going to be tax-free and penalty-free. All right, so that's 1. 2, they're going to give you conversions next on a first in, first out basis, or FIFO, first in, first out. So again, you can put contributions in out of your paycheck with after-tax dollars. You can, number 2, convert from an IRA that you put in tax deferred and move it to tax free. And 3 is going to be earnings last, which may or may not be taxable depending on other rules. And there's a 5-year vesting rule that basically 20% of the growth every year stacks. So if you take all the growth out of it in the first year, 80% is taxable, 20% is tax-free. Next year, 40, 60, 80. At the end of the 5 years, you take out your contributions, conversions, and growth, all tax-free. So it's that 5-year rule. So keeping multiple Roth IRAs doesn't change the tax outcome. They're all viewed as just one big account.
Okay, excellent. So you could pull money out from multiple different Roth IRAs in theory, and if it's all contributions, it's all going to be treated that same way.
Yeah, so it's going to be the amounts that they're keeping track of the amounts. Yes.
Okay, gotcha. All right, so moving on from there, I know there's some rules around the contributions themselves always accessible as tax-free. Is that right?
Yeah, so step number 2, your contributions are always accessible tax-free. So you can always withdraw your Roth IRA contributions tax and penalty-free at any time. Why? Because you've already paid the taxes on those dollars. So this makes Roth IRAs a flexible emergency fund in retirement planning, and I would say as a last resort for most part. Though ideally, you want to let those dollars keep compounding tax-free for as long as you can.
Okay, excellent. So this is where we start getting into the details of where you can trigger, this sounds like this great tax-free plan, and in many ways it can be, but there's a lot of pitfalls and things that can trip you up that then cause problems if you don't follow the rules.
Yeah, so step 3, you definitely want to keep an eye and watch out for the 10% penalty on your converted funds, not contributions, but your converted funds. So converted amounts are not taxed again when they're withdrawn because why? You've already paid taxes at the conversion. But if you're under the age 59 and a half and take out converted funds within 5 years of the conversion, you could face a 10% early withdrawal penalty. So you need to be careful on that. Now, each conversion has its own 5-year clock. So you've got to be aware of that as well. And if you're over 59 and a half, you're in the clear. There's not going to be a 10% penalty that applies to the withdrawal.
Scott, I'm hoping just for a moment, if we can do a little sidestep here, can you explain a little bit more in depth that whole concept of the 5-year rule? It seems like something that's got some nuances to it.
Oh, definitely. And there's a lot of misconceptions out there. And so we'll definitely break it down. So the 2 5-year rules. So rule number one, it's the 5-year rule for earnings. And we kind of touched on that earlier. So what is it? It's the rule that applies to the earnings on your investment. When does that clock start ticking? It's January 1st of the tax year you make your first contribution or conversion to your Roth IRA. So what that means is for your earnings to be withdrawn tax-free, that account must be open for at least 5 years to be totally tax-free on the earnings. And rule number two is the 5-year rule for converted money. So what is it? It's the rule that applies specifically to the principal you converted from a traditional IRA to a Roth IRA. Same starting clock, January 1st of the tax year of the specific conversion. What it means, it's for the converted principal to be withdrawn without a 10% early withdrawal penalty, you must have held that specific converted amount for at least 5 years. So let's give you an example of how this actually works in practice. If you're under 59 and a half, both the 5-year earnings rule and the 5-year conversion rule are critical. So if you withdraw converted principal before the 5-year period, before the conversion is up, it will likely be subject to the 10% penalty, even though the principal is not taxed again. So that's below 59 and a half. If you're above 59 and a half or older, the 5-year conversion rule for penalties on converted principal becomes moot. So out the door, don't have to worry about it. You can withdraw the converted principal penalty free as long as the overall Roth IRA account has met its own 5-year earnings rule. So an example, if you're under age 59 and a half, let's say you convert $10,000 on April 1st of 2025. On March 1st of 2028, you withdraw $5,000 of that converted amount. Since the 5-year conversion period won't be met until January 1st, 2030, the $5,000 withdrawal would likely be subject to a 10% early withdrawal penalty. So again, that's under age 59 and a half. Now, above 59 and a half or older, your Roth IRA was open in 2018. You perform a Roth conversion in 2024. Now, if you withdraw the converted principal in 2025, it will not be subject to the 10% penalty because you're over the age of 59 and a half, even though you haven't met the 5-year conversion holding period. Clear as mud, isn't it?
Clear as mud. I'm sure our engineers are loving this, though, Scott. They like diving into these kinds of details. So if you're not an engineer, just skip forward like another 30 seconds, and we'll get to the next step for these Roth conversions. But yeah, put a bow on this piece of the equation for us here, Scott.
So some key takeaways for this: you can almost always withdraw your original contributions and not converted principal from a Roth IRA without taxes or penalties, regardless of the 5-year rules. Now, for earnings and converted principal, you typically need to have met both the account's 5-year rule and the conversion's 5-year rule to avoid taxes and penalties. Now, here it is. You're responsible for tracking these holding periods. Now, there are exceptions that allow for penalty-free withdrawal, such as for qualified education expenses, first-time home purchase up to $10,000, disability, or death. So there are ways to get that out of there. I think the final key takeaway on this is, we do tax planning in our firm. We have a tax preparation firm, a CPA, and staff that goes through all of this for our clients and make sure everything is done correctly. We even go as far as, if we're doing our clients' taxes, we fill out a form that if our client gets a form or a letter from the IRS, we get the same letter. So when it's hitting their mailbox, it comes to us as well. We're opening it. We're usually calling out to our clients before they're calling us. And so that's a nice little takeaway or a safety net for clients that we're doing their taxes from the firm.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
Okay, very good. So that is a great breakdown during step 3 here of how those conversions certainly have that 5-year clock and some of the nuances around that. Step 4 is to know when the earnings are tax-free. So kind of zooming back into this Roth IRA conversation, we've pivoted a little bit from the contributions now to this kind of important piece of the earnings.
Yeah. So step 4, and we really we're kind of rehashing what we just talked about. But step 4, know when earnings are tax-free. So again, your earnings are tax-free only if your withdrawal is a qualified distribution. And again, to be qualified, it must meet both conditions. You've owned any Roth IRA for at least 5 years, and you're 59 and a half or older, or the withdrawal is due to death, disability, or first-time home purchase, up to $10,000. And if you miss either of those earnings could be taxable.
Okay. Excellent. So the goal, right, of this whole thing is to try to make these tax-free. Nobody wants to pay the 10% penalty, certainly. And then also we don't want to have taxes triggered on these things.
Yes. And again, step 5, we talked about the 5-year clock for qualified distributions. You know, we gave a lengthier discussion and an example, but as to rehash it, the 5-year period for qualified distributions starts, again, January 1 of the year you make your first ever Roth contribution. It doesn't restart with each new contribution or conversion, okay? So an example, you convert $1 in 2020, and in 2022, you convert a $1 million IRA.
Okay.
By January 1st, 2025, all funds are considered aged 5 years and are eligible for a tax-free qualified withdrawal. So track your start year. It can mean the difference between a tax-free or taxable withdrawal. That's one of the things we talk about. If you have kids, grandkids, get them to open a Roth as soon as possible to start that clock.
Scott, just a quick important distinction there, because that was really kind of an eye-opener for me, at least. Again, viewing these all together, what you're saying is I can open up an IRA when I'm 20 and just contribute a tiny amount to it, and it might be 20 years later, I make a conversion. I'm good because I've had multiple years lapse that from my starting date. Even though it's in a different Roth account, it's all treated the same.
Correct. Yeah. So the sooner you do a Roth contribution and get that clock, that starts the clock ticking. And that 5-year aging, do it as soon as possible. So if you've worked hard to build your Roth IRA, don't let a small rule break your chance at tax-free income. At Elevated Retirement Group, we help clients structure Roth strategies that maximize tax-free income for life. So schedule your discovery call today and to make sure your Roth dollars are working the smartest way possible.
All you have to do to schedule that time with Scott and the team at Elevated Retirement Group. Again, we can cover kind of the high-level stuff here on the show, but to talk one-on-one about your situation with a member of the team, all you have to do is check the link in the description of today's show. Whether you're watching on YouTube or listening on your favorite audio app, you'll find that link. Schedule your time to meet, have a discovery call, see if you're a good fit to work with one another, and then take the steps to putting together that solid financial plan that not only answers questions about Roth IRAs and taxes, but so much more. A comprehensive guide to get you to and all the way through retirement. So check the link in the description of today's show for more information and to book your time to visit. And Scott, thanks for all your help today.
Thank you.
This podcast has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this podcast is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt, Mark Killian, and Third Wheel Media LLC are not clients of Elevated Capital Advisors. They receive cash compensation for their assistance in preparing and hosting this podcast, and for providing the endorsement contained in this podcast. Because Walter, Mark, and Third Wheel Media are compensated in connection with this podcast, they have a material conflict of interest in providing their endorsement.